Today, we are going to break down what is, without a doubt, the single most important skill for surviving and, yes, thriving in crypto trading: capital management. Look, this isn't about chasing those wild, massive gains. It's about making sure you have the money to stay in the game long enough to actually win. So let me just start with a question. When you look at the pros, the people who actually do this for a living, and you compare them to the 90% of traders who lose money, what's the one thing that truly separates them? Is it some secret indicator? A crystal ball, maybe?
Nope, it's this. It is as simple and as powerful as these two words. The way they manage their money is the absolute foundation of their entire career. This right here, this is the real secret weapon.
And that brings us right into our first section, where we're going to explore why capital management is truly the key to survival in the crypto markets. See, before you can even think about winning, you have to master the art of not losing. Let's be real for a second. The crypto market is the Wild West. It is incredibly volatile and just packed with risk. If you don't have a solid strategy for managing your funds, it's not a question of if you'll have a devastating loss, it's a question of when. One bad decision, one bet that's just a little too big, and poof, your account can go to zero. So what are we actually talking about here? Well, think of capital management as your defensive strategy. Its number one goal is not to make you rich overnight. Its goal is to protect your account from those catastrophic losses, making sure you can stick around and trade for the long haul. Okay, so if survival is the main goal, how do we actually do it? Well, it all starts with a simple, yet incredibly powerful guideline that professional traders live and die by. We call it the 2% golden rule. And here it is, 2%. That is the magic number. The core idea is this: you should never, ever risk more than 1 to 2% of your total trading capital on any single trade, period.
Now, the logic behind this is just so powerful. By capping your risk at 2%, you make it mathematically almost impossible for a string of losses to completely wipe you out. Research has shown that this level of risk lets you withstand those inevitable losing streaks without facing financial ruin, which keeps you in the game to catch the next big win.
And this is where it gets really exciting. The long-term power here is incredible. It's simple to use, it works whether you have $100 or $1 million, but the best part? As your account grows, that 2% becomes a larger dollar amount. This creates a natural compounding effect which accelerates your growth in a really controlled, sustainable way. It's how small accounts become big accounts. Okay, so the 2% rule is the what. Now we have to cover the how. How do you actually apply this rule to every single trade you make? This is where the core technique of position sizing comes into play. And it's a beautifully simple two-step process. First, you figure out the maximum amount of money you're willing to lose on this one trade. Second, you use that number to figure out how big of a position you can actually open. That's it. So step one is just some basic math. You take your total account balance, everything you have to trade with, and you multiply it by your risk percentage, which, as we've said, should be no more than 2%. That gives you your risk amount in actual dollars. Let's make this super concrete. Let's say you have a $10,000 account. Applying our 2% rule means the absolute most you can risk on your next trade is $200. Now, if that trade goes against you and you lose, you're down to $9,800. Are you happy? Of course not. But are you out of the game? Absolutely not. You just recalculate your 2% on the new balance, and you're ready for the next opportunity. Okay, so you figured out your maximum risk is $200. But how does that translate into how much Bitcoin or Ethereum you can actually buy? Well, this is where the second critical piece of the puzzle comes in, your stop loss. A stop loss is basically a preset order to sell your crypto if it hits a certain price, which effectively caps your potential loss. The distance between where you buy and where you set your stop loss is what's going to determine your position size. And that brings us to our final and maybe most important section. You see, having all the rules and formulas is one thing, but the real strength comes from the mindset you build around them. Following a strict capital management plan, like the 2% rule, does something absolutely amazing for your psychology. It basically removes emotion from the equation. When you know, for a fact, that your maximum loss is predefined and survivable, you're so much less likely to make decisions based on fear or greed. It helps you stay rational and actually execute your plan. So here's the bottom line. If you remember nothing else from this, remember this quote. The goal of a professional trader isn't to hit a home run on every single trade. The goal is to protect their capital so they can stay in the game long enough for their strategy to work. Preservation always comes before profit. Which leads us to the final, really practical question.
We've established that your position size depends on your stop loss. So, how do you figure out where to place that stop loss? And how to use take-profit orders to lock in your gains? Well, that is exactly what we're going to be breaking down in the next explainer. We'll see you there.